So under the qualified mortgage currently today, as it is a rule that is going to be passed and go into effect in January of 2014, there are certain restrictions. One, a loan originator must prove the person has the ability to repay the loan, which means they have to qualify them on income, make sure they qualify on assets, and there's different types of restrictions to ensure that you have done your due diligence to make sure that person does have the income, does have the assets, etc. Now there's certain debt-to-income ratios. Currently right now it's our maximum debt-to-income ratio of 43%, and the points and fees cannot exceed 3% of the loan. That runs into problems sometimes between sometimes a brokered loan and a bank loan, because the way the CFPB is interpreting, for instance, points and fees is that any types of margins that are paid to a mortgage broker are included in the points and fees. Now on the banking side that does not occur. So unfortunately what we're seeing right now is a disproportionate understanding where the CFPB seems like they're choosing winners and losers in a transaction, because on the broker side, that margin that they get paid from a creditor to themselves is included in that cap, while the banker side it doesn't. Now here in the state of California we kind of did a sheet and we kind of saw is in a purchase transaction anything less than $200,000 would fall outside of the qualified mortgage. And we've heard Director Cordray basically say that he does expect lenders to lend outside of the qualified mortgage. The only problem with that, and I don't want to go down the rabbit hole because it kind of took me a whole weekend to really understand the difference between what's called safe harbor and what's called rebuttable presumption. So this is going back to square one. So to achieve safe harbor under qualified mortgage, you must achieve, again, the 43% debt-to-income ratio. It must be the points and fees cap cannot exceed 3%, and it cannot be a high-priced loan. So as long as it does that, you achieve safe harbor. So if a client comes to you and says, okay, you did not prove that I had the ability to repay the loan, a judge will look at it and say, okay, you fit within the qualified mortgage. You did it. The lawsuit gets thrown out of court. You do not have to defend yourself. But if it's a non-QM loan, so in other words that the debt-to-income ratio maybe exceeds 43%, points and fees exceed 3%, or it's a high-priced loan, you still have the ability to defend yourself, but now you have what's called a rebuttable presumption, which means you have to defend yourselves in a court of law. You may be in the right, you may win the lawsuit, but guess what? You still have to hire an attorney. You still have to defend yourself. So the question always is like, will a lender ever do loans outside of the qualified mortgage? Well, why would they? Because they would have to defend themselves every single time, even though they're in the right. And so that's why we see there's going to be some sort of contraction going on, we believe, after January, where we're going to see the underserved who was supposed to help is actually going to be harmed. Again, kind of going back to the unintended circumstances. Now, there are some carve-outs. So currently right now, any loan that is within the U.S. government control, Fannie Freddie, which is still right now under U.S. control, FHA, USDA, VA, those have the carve-outs. So as long as those are approved within those parameters, it is considered a qualified mortgage because they actually have a 7-year exemption. So what the intent was is that those individual entities would actually create their own qualified mortgage. And we actually saw that. Actually, Fannie Freddie came out and said, we have our own new qualified mortgage. We're going to follow the same rules that, that the QM has already put into place. So they've already come out and said that.